Start with group term life insurance. It's a non-taxable fringe benefit, but only up to a point. The employer-paid cost of the first $50,000 of coverage is excluded from the employee's income. If the employer pays for coverage above $50,000, the cost of the excess coverage becomes taxable to the employee. On the EA exam, they love that first $50,000 is excluded rule. Now add dependents. Group term life on a spouse or dependent can be treated as de minimis only if the coverage is $2,000 or less. Here's the trap. If it's more than $2,000, you don't just tax the excess. You include the fair market value of the entire dependent coverage in the employee's income. That all or nothing at $2,000 is very testable. HSAs are different from FSAs because the HSA is owned by the employee. That means contributions, whether from the employee or employer, become the employee's property and stay with them if they change jobs. HSAs also pair with a high-deductible health plan. So when you see portable and immediately vested, think HSA, not FSA. Employer HSA contributions have a comparability rule. If employees have comparable coverage during the same period, the employer generally must contribute comparable amounts. If the employer doesn't, there's an excise tax equal to 35% of the total employer contributions to all employees' HSAs. One nuance the exam may test: the employer can contribute more for non-highly compensated employees than for highly compensated employees. Discriminating against HCEs is allowed here. Medicare is the hard stop for HSA contributions. Once you're enrolled in Medicare, no new HSA contributions are allowed. If contributions still happen, they're excess contributions and can trigger a 6% penalty tax unless corrected by the deadline. Generally, the HSA owner's return due date, including extensions. On the exam, watch the wording. It's Medicare enrollment that ends eligibility, not just turning age 65. FSAs are cafeteria plan benefits funded mainly through salary reduction. Reimbursements for qualified expenses are tax-free. The two common types are healthcare FSAs and dependent care FSAs. Dependent care FSAs have a hard annual limit, $5,000 per family or $2,500 if married filing separately. And dependent care has an extra cap. The exclusion can't exceed the smaller of the earned income of the employee or the spouse. FSAs also come with the famous use it or lose it concept. Employers can soften it in one of two ways: either allow a limited carryover of unused health FSA amounts, or allow a grace period of up to 2.5 months after year-end to spend the remaining balance. But they can't offer both. If the employee still doesn't spend it by the deadline, the leftover is forfeited back to the employer. Finally, QSEHRAs. A qualified small employer health reimbursement arrangement lets a small employer reimburse employees for individual health coverage premiums and other medical expenses, up to an annual limit. Key eligibility: the employer must have fewer than 50 full-time employees and cannot offer a group health plan. Also, QSEHRAs are employer-funded only, no employee contributions. The exam hook is recognizing when a small employer can use this instead of group coverage. Summit Capital Partners is a C corporation paying quarterly dividends. The IRS notifies the corporation that one shareholder's Social Security number is incorrect. What is Summit Capital Partners required to do? The choices include reporting the shareholder for fraud, correcting the error, or withholding at 37%, correcting the error or withholding at 24%, or withholding all dividends until it's fixed. Think about it. The correct answer is correct the error or begin backup withholding at 24%. When the IRS notifies a payer that a payee TIN is incorrect, the payer must solicit the correct TIN, and if it's not corrected, backup withholding applies to reportable payments like dividends. The 37% option is tempting because it sounds like a top rate, but backup withholding is generally 24%. What happens when an employer's cafeteria plan favors highly compensated employees or key employees in contributions, benefits, or eligibility? The options include an excise tax on the employer, adding income to the favored employees, disallowing all compensation deductions, or treating it as a prohibited transaction with suspended benefits. Think about it. The correct answer is that the favored highly compensated or key employees lose the tax-free treatment and must include the value of the taxable benefits they could have selected in income. That's the classic cafeteria plan non-discrimination consequence. It hits the favored individuals, not by disallowing the whole plan for everyone. The excise tax answer is tempting, but that's not the standard cafeteria plan penalty.